to alleviate all the segments from the strength of the US dollar that we've seen in recent times. Let's understand what the RBI is trying to do over here. For that, my colleague Mythili Bhusnurmath, consulting editor at ET Now, is joining us to help understand this move and what the possible fallouts and perhaps the good news could be on this count, considering that the rupee has been falling, Mythili, among these altered norms. Now, the RBI is temporarily allowing banks to raise fresh FCNR and NRE deposits without reference to the regulations that exist on interest rates. If you can explain to us this move and how much you think this could possibly help in the RBI's attempt to bolster its Forex reserves and, of course, save the rupee from declining any further.
Well, I'm not sure how much it will really help prevent the rupee from depreciating, because we must remember that part of the reason for the depreciation is the dollar strengthening, because when we talk of the rupee weakening, it is vis-a-vis the dollar. So I'm not sure how much these measures will help. On the contrary, it might spread more panic in the market simply because with our substantial reserves, in fact, the RBI has been tom-tomming from the rooftops that we have substantial reserves. And it is true that, about a year ago, we had about $642 billion in reserves. Now they have fallen to about 590 billion, but that is still a substantial nest egg. So when the Reserve Bank is asserting again and again that we have enough reserves, to now react like this seems to suggest that maybe the Reserve Bank knows something more. Maybe it fears the rupee will fall much more, because the Reserve Bank stand, which has been reiterated again and again, is that the Reserve Bank is not against the depreciation of the rupee. What it is against volatility, against very sharp movement, either upward or downward. Of course, what we've been seeing now is downward. So the Reserve Bank of India has always held that it intervenes to smoothen the volatility. If that is the case, even though the rupee has declined, in fact, we saw it yesterday at about cross at 79.37, and today also we saw it close at 79.30. So clearly the 80 rupees to the dollar is not very far off. But when the Reserve Bank reacts like this by easing the restrictions on interest rates, allowing banks to raise money abroad, to lend in foreign currency here, easing the restrictions on exchange, external commercial borrowings, all these seem to suggest that the Reserve Bank is panicking somewhat. And when the central bank of the country panics, then the market panics even more. So I'm not very sure that the benefit will really the upside will be more than the downside. Tomorrow, when in fact the market opens, we might see the rupee fall even further, simply because people fear. What is it that the Reserve Bank knows? Why is it reacting like this? Remember, we also saw a report in today's Economic Times saying that a substantial amount of external debt is due in the next 9 months. Now, all these signals are likely to send markets into a bit of a panic. So I'm not sure that the benefit will be more than the cost. So I think this seems a bit like a knee-jerk reaction, particularly since we have substantial reserves. Of course, one must remember that foreign investors have been pulling out big time from the equity market.
This is true. And if this is a knee-jerk reaction, one has to understand this in the context with what the center has been trying to do as well. They've raised those import duties on gold. They've raised levies on exports of petrol and diesel. Obviously, all these are attempts to control the widening current account deficit. Do you see the center and the RBI working in tandem, at least, to manage the falling rupee, to bolster Forex reserves, to control inflation and keep the growth engines chugging? Do you see that kind of move?
Well, the Center and the Reserve Bank of India have been working in tandem ever since COVID hit us. At the moment, the Reserve Bank of India's attention really is on inflation control and on managing the exchange rate. As I said, managing volatility. The government has been helping with administrative measures, but whether these can really help prevent the current account deficit from reaching that very dangerous 3% mark is a little doubtful, simply because the ultimate answer for a widening current account deficit is really a fall in the price of oil. And that is something that we're not likely to see as long as the conflict continues in Ukraine.
With regard to external commercial borrowings, the RBI has also now decided that they are going to increase the limit under the automatic route from what was $750 million, or its equivalent every financial year. Now it's been raised to $1.5 billion. Do you think this could possibly attract more takers at a time the world economy is slowing down and our manufacturers who export, for one, they're seeing their global markets shrink, they're contracting right now with the kind of global slowdown we're talking about?
Well, I'm not so sure, simply because some of the external debt that is due, external commercial borrowings, the better corporates will be able to roll it over. But remember, they'll be able to roll it over at a higher cost. So ultimately, this might be a short-term tiding over of the problem and only kicking the can down the road. So I'm not very sure it will really help long-term measure. So this is clearly a short-term measure, and I'm not very sure that the Reserve Bank really thought, ought to have done this, simply because, as I said, markets always fear that the central bank fears more than what they know. And that, given the size of our reserves, of course, one must remember also that our reserves are essentially borrowed reserves. They do not come out of current account surpluses, and that makes a difference. But even so, I'm not very sure that this was really warranted at this time, given the kind of reserves that we had.
The other measures, Mythili, it also includes letting foreign investors invest in short-term corporate debt and allowing the purchase of more government securities under the fully accessible route. At a time that we've seen so much flight of foreign capital, how effective a tool could this be in arresting that?
See, corporate debt has never been very attractive. In fact, the limits that have been laid down have never been fully utilized, simply because overseas investors fear that when corporates do not repay, then they really have very little recourse. As we've seen in India, it's very, very difficult to get back your payments because the entire thing gets stuck in court. So corporate debts have never been very popular. On the contrary, government securities have been fairly popular, even though there have been times it has not been fully utilized, simply because the government has never defaulted and will never default on its own borrowings. So the FAR, the fully accessible route, might find some greater success. But as I said, I'm not very sure that this was really warranted. It might seem a bit like a knee-jerk reaction and might do more harm than good.